It is not every day you read an earnings report and find a highly specific, literal price tag attached to global conflict. But here we are.
Yeah, a quantifiable 2 to 3 cents a share, to be exact.
Right. Welcome to Earnings Unscripted, where we translate the noise of the market. Today is April 21st, 2026. We are looking at Halliburton, ticker HAL, unpacking their first quarter results. And just really quick, none of this is financial advice, just two friends overanalyzing corporate filings for fun. So please do your own research. But Miro, this is wild. You think of Halliburton as the guys out there physically cementing wells, fracking the shale. You expect commodity problems. You do not expect an itemized invoice for geopolitical shipping logistics.
Look, the service side of the oil sector usually just complains about broad macro headwinds when things slow down. They do not do this. They explicitly said suspended rigs and routing chaos cost them real money this quarter. And then they basically said, prepare yourselves, second quarter is going to be 3 times worse.
Which makes the market reaction almost comical to me, because earnings came in at 55 cents a share, down from 70 last quarter.
$5.4 billion in revenue. That is roughly a 4.5% sequential slide, roughly flat year over year.
Right, except the stock didn't care at all.
Not even a little. The market completely ignored the geopolitical hit. The stock was already on a tear during the quarter, up something like 38%. Earnings drop, the stock gaps up to open at $38.03, and then the intraday tape just stabilizes. It flatlines in a tight range and closes regular trading at $38.15.
Total conviction. So they shrug off the revenue drop because operating margins are still hanging around 12.6%. I mean, they're making decent money on lower volume.
That is part of it, but the real driver is scarcity. The CEO came out and said the white space on their North American fracking calendar is gone, completely sold out for the first half of the year.
So if you're an oil producer and you suddenly need a crew to frack your well tomorrow, you are out of luck.
Pretty much. They're within a handful of fleets of having absolutely nothing left to rent out. That gives them absolute pricing power. They're dictating terms, focusing entirely on returns instead of fighting for market share.
And we're not just talking about Texas anymore either. They're taking their premium, fully electric Zeus frac fleets outside North America for the first time, shipping them to Argentina.
Yes, the Vaca Muerta basin is graduating into the big leagues now. Multi-billion-dollar contracts over there.
Okay, there is a lot of hidden machinery operating beneath these flat headline numbers. Let's get into the details.
And that machinery is not exactly running cheap right now because, look, if we want to find the real stress test in this quarter, we actually have to talk about cash flow. The headline earnings held up, but the cash generation completely fell off a cliff.
Down from Q4, right? I know the end of the year is usually their strongest quarter for cash collection, but still.
No, it is a massive drop. Free cash flow went from $875 million at the end of last year down to just $123 million in Q1.
Okay. Wow. 123. That is practically nothing for a company doing $5 billion in revenue. So what caused that? Just a ton of delayed receivables?
A lot of it is working capital building up, some seasonal stuff, sure. But the fascinating part to me is how management reacted to it. They had this very public framework where they promised to return 50% of free cash flow to shareholders, mostly through buybacks.
Right, which is the whole playbook for these oil field companies right now. Just aggressive buybacks to prop up the stock.
Yes, except this time they quietly pumped the brakes. Historically, they buy back around $250 million in stock a quarter. This time, they only spent $100 million. Technically, $100 million out of $123 million in cash flow means they easily hit their percentage target. But in absolute dollars, they starved the buyback program.
Which tells you they are spooked. I mean, they're not saying they're spooked, but capital allocation never lies.
That is the crux of it. The CEO basically admitted it on the call. He said they intentionally acted conservatively because they were watching the Middle East timeline unfold. It's smart corporate finance, don't get me wrong, but it definitely contradicts the bulletproof confidence they project everywhere else in the report. They have $2 billion in cash sitting on the balance sheet, but they still clamp down.
Well, and it's funny you mentioned the costs because there was another leak in the bottom line that honestly just made me laugh. They're burning $42 million a quarter right now on an SAP software upgrade.
Oh yeah, the great S4 migration. The silent killer of margins.
Yes, and the CFO casually mentions it's going to cost another $45 million in Q2, and it doesn't wrap up until the end of 2026.
I think it's just so relatable. Even these multi-billion-dollar energy giants are held hostage by endless IT upgrades.
It's friction.
It's roughly $50 million of pure margin friction every 3 months. But, if we're looking at where their capital is actually generating real leverage, I want to look at the offshore technology. They finalized an acquisition this quarter that I think the market is completely overlooking.
You mean the Sekal buyout? Because I actually loved reading about this.
Yes, so they bought Sekal, which is a rig automation software company, and they immediately merged it with their own internal drilling platform.
And this is where the industry really starts to sound like science fiction to me, because when you think about offshore drilling, especially these ultra-deepwater projects they are doing down in Guyana, you are drilling miles into the ocean floor. The physical danger and the financial risk of human error are just immense.
It is basically aerospace engineering, but underground. One slight hesitation from a human operator and you destroy a drill bit that costs millions or worse.
Exactly. And the COO, Shannon Slocum, he had this great line explaining the deal. I'm quoting him here. He said, "This means Halliburton has the technology in-house to fully close the loop for automated geosteering."
Right, closing the loop. Meaning they took the human out of the immediate feedback cycle.
Yes, the rig basically steers itself now. It dynamically reads the geology and adjusts mechanically without waiting for a guy in a control room to push a button or make a judgment call. They deployed it in Guyana recently and said the drilling times were unexpectedly fast.
Well, algorithms do not second-guess themselves.
Very true. But what strikes me is the strategic side of it. They brought the brain of the rig completely inside the company.
That's the real play here. You absolutely do not want to license your most critical efficiency driver from a third-party startup forever. By buying Sekal out, they own the IP, they capture the efficiency gains, and they lock clients into their ecosystem. You want the automated rig? You have to hire Halliburton to run it.
It's an incredible moat. It takes these unpredictable, high-stakes deepwater plays and turns them into reliable manufacturing processes.
Which is exactly what the global majors paying for these mega projects are desperate for. Predictability.
Right, predictability, which feels incredibly relevant right now because between the geopolitical disruptions, totally wiping out supply chains, and these new international expansions, where does this actually leave their financials heading into the next quarter?
Well, it leaves them navigating a calendar they basically do not control. If you look at the Q2 guidance, the core completions business is holding up. They actually expect sequential revenue to jump 4 to 6% there. But the international side is just bracing for impact.
Right, because the CFO actually said their Middle East assumption is, quote, a bit of our best guess, which is just wild to hear on an earnings call.
Very wild. They are baking in a 7 to 9 cent EPS hit, assuming those suspended offshore rigs restart halfway through the quarter. And if that timeline slips, it is probably another 3 to 5 cents gone.
Sorry, and the D&E margins are dropping too, right?
Yes, but that is really just the seasonal software sales from Q1 rolling off. It looks bad on paper, but it is normal cyclical noise.
Okay, so you have this really challenging Q2 setup. Suspended rigs, unpredictable restart dates, software seasonality, and yet the investors are incredibly patient right now. Why give them a pass?
Because the macro narrative has fundamentally shifted. The CEO was emphatically bullish on the call. He told analysts, and I love this phrasing, the supply overhang is no longer a concern. That is swept away.
Swept away. That is a heavy statement.
Exactly. He is arguing that global energy security is the absolute priority now. So the market is looking right past a chaotic Q2 because beneath the logistics nightmare, they see a permanently tighter supply chain where Halliburton holds all the cards.
I like that. It feels like they are betting the geopolitical chaos is temporary, but their own pricing power is permanent, at least for this cycle.
Assuming the offshore work actually resumes when they think it will, yes. It's a fascinating high wire act.
Let us hope they don't look down. Well, I think that sums it up perfectly. They have brilliant tech and a sold-out domestic market, but they are playing on a very messy global board.
I will definitely be watching that restart timeline in July.
Absolutely. All right. Thanks for dissecting this one with me, Miro. And thanks, everyone, for joining us to make sense of it all. Stick around for a very quick note on how we put this episode together. If you want these breakdowns to just quietly show up in your feed, you might want to hit follow on the podcast. And just as a peek behind the curtain, we do use AI to help process those massive earnings filings and generate our audio, but the numbers all come straight from the real reports. If there is a specific company you want us to look at next, drop us a line at earningsunscripted@datamadness.ca or grab the X link down in the show notes.
Talk to you then.